Welcome to Charts This Week. A big week ahead with everything that's been going on in global markets. We've had obviously the turmoil of the Middle East and now this tragic earthquake in Japan. It's really what this means for markets is hard to say, but of course the key thing about charts is that they do absorb news very, very quickly indeed. So a lot of these things are already priced into the charts and the news flow. What's interesting here is that this is a chart of the MSCI World Index, and you can see here that in fact what's happening on the long term, and this is a really long term monthly chart, what's happening on this long term chart is that price action for stock markets is opening out and out and out, meaning they're not trending the way they were in the 80s and 90s. They're becoming harder and harder to predict, and the price gyrations are becoming bigger and bigger. So until we see some narrowing of price and then trending, it really is quite hard for stock markets globally. Of course, there will be different cases within that, but the overall picture of global stock markets is one of more unpredictable price behavior. And if we look at the S&P 500 index, the biggest weighting in that world index, of course, we see here how we had that run. Again, this is a monthly chart. The cloud, we came back from 2000, came all the way back to a more sensible level, lagging line testing right on the cloud, and then we kept going out, and it really was saying at this point that it was only really a correction, but the fact that we couldn't get to a new high was really significant. And just think about what this means. When all the people that bought here, when the price gets back here, they say, oh, thank God, the price has got back to where I bought at. I'm getting out. At least I got my money back. There are people down here who bought way back here who said, I should have got out that time, who then when it gets to this time say, oh, I'm really glad that I can get out at that price again. And of course, there are people here who say, well, that's enough of a profit to make in the shorter term. I'm happy to take profits here. So this resistance, they sold there before, they sell there again. So we'd expect this 50 level on the S&P 500. If we do get to that level, we would expect again very strong resistance, having tested this level twice in this long-term chart. And similarly on the buy side, people saying down here, I should have bought the market there last time, they buy it here this time. So we see all sorts of crowd psychology going on in this chart. But the fact is, we came through the cloud. This is bearish on the lagging line, so bearish long-term, below the cloud. Just popped through in the end of last month, but 1 month is not enough. We need a few months before we can really say that we're bullish on this chart. We can't just rely on one candle as such. And it's quite a mountain for the market to climb to get bullish above this cloud right now. Chances are that we're probably going to wander more out sideways into this bullish zone than we are just going higher and higher and higher. So this chart telling us that we've still got, in the very long term, years, the market could take quite some time before it makes a new all-time high. If we look at the daily and weekly charts, the picture is quite different. These are bullish. Daily, we're thinking weeks and months ahead. Weekly, we're thinking months and year ahead maybe. So here we see that the trend for the rest of this year looks reasonable, but because we're extended, there's a good chance that we'll come back, maybe test the daily, even possibly fall through the daily and give a sell signal in the medium term to come back and test the weekly chart. So the clouds are going to tell us, but at the moment it's saying that we've got levels that we could pull back to and still stay bullish on these time frames. If we look at the 60-minute chart on the S&P, picture is quite different here. We see the run above the cloud. We had this 3 month extended run in a 60-minute chart, very unusual. Really did mean that at the end of this move, we should have expected some sell-off. And we do see here that the cloud is now acting on us. In fact, we had lower high, then lower low on Thursday last week. We closed to a lower low. Dow theory tells us that's the start of a downtrend, and so we should be worried. It may not be as long-lived as this one, but we can see here the daily chart overlaid. If we could expect to see the base of this chart around 1240, 1250 is the base of the cloud on the daily. So we would expect markets to have a pretty tough few weeks based on that chart. And here we see the downside targets on the S&P that were given, then upside targets 1270, 1300. This is on the 10 by 3. Given no new targets. In order to get a new target, we need to pull back, and then we need a new buying thrust to give us a new upside target. So at the moment, it's really hard to see any upside on this chart. And then if we look at the 5-minute chart, same again. We don't have the targets here. We have a downside target of 1250. That matches that cloud base, so it does give credence to this sort of level of a 4% sell-off in the market to come back and to test this level. So the 5 by 3 does have this downside target, which is activated, but it is counter trend. Of course, if we make a new high, all of these downside moves come off, and then we're looking for where is the next level of resistance. If we look at the 1% chart, this is really quite difficult to construct yourself, but if you're a 1% chart, 1344 was the target that we had in 2010, 1385, a target that might just be a push too far. Probably we need, based on those other charts, we need a pullback and a new buying thrust to give us a new upside target. If you look at the 1-minute chart, if you're trading the S&P minis, you're trading S&P, these 1-minute charts, absolutely critical for giving you short-term targets. So these 1-minute thrusts, 1258, 1252, these thrusts pointing again, these intraday uninterrupted selling thrusts, pointing, 2 of them pointing to around this 250 level. That's a cluster. So it does suggest downside, little mini upside target. You've got to watch this chart. The 1-minute chart changes quite quickly, remember, so keep a close eye on that this week. But more and more we're seeing this 1250 level. This is fascinating. This is the S&P daily chart. We see the trend really here being breached. This is the bullish percent. This is the point and figure bullish percent, and we see here that in the last few weeks in the US, 15 stocks, we've gone from 85% to 69%. 15 or 16% of US stocks have given sell signals. And what's more, the market kept rising, but we never got more bullish, no more buying, no extra buying, although the market was going higher. So we were running out of new stocks getting bullish because you can't get any more bullish than very bullish. And so interestingly, this is telling us also from a sentiment perspective that there's downside risk here in the market. And so that's just a little bit of information that's not so readily available in the chart itself. If we look at the targets for the Dow, 12,400 was the target. We saw this 10.55, 10.5, 12.4. Again, we're missing an upside target on the Dow. We need to pull back and then a new thrust to give us that upside. So at the moment, really hard to see any downside on the upside on the Dow. And again, the 60-minute cloud chart, very similar picture to the S&P, through the cloud, making lower lows, suggesting we're going to unwind some of this move. You could, of course, put a Fibonacci trend retracement on there, but around 50% of the move is what we might expect to see retraced. And if we look at the 1-minute chart, again, this is changing very rapidly, real time on the system. You need to keep a close eye on this, but 11,700, a 300-point sell-off, or we've got a little bit of a target that's come in, but it is counter trend. Need to see how the US behaves in the first few days of this week to really watch the new short-term targets kicking in. And then if we look at the NASDAQ, this 38.2 Fibonacci level, this is the monthly chart. Not many people look at monthly charts, but this big fall on the NASDAQ is what's creating the resistance now, about 2,330. We're really struggling at this 38.2 level. Tech has outperformed. It does not showing up so clearly in this chart, but tech has really outperformed. It's gone from sort of 40%, this is normalized, 40% up to 65%. So it really has done better than many other markets. But if we look at the targets given and met, so these upside targets were quite accurate. We just broke this previous level, which is quite exciting. We're making a multi-year high on NASDAQ. Very exciting indeed, but no upside targets on this chart. If you take a look at the 50 by 3 on NASDAQ, there is an upside target, but it's only on its own and isolated. You need to see some pullback and targets on this one. So really quite key that tech is outperforming, but there's an absence of upside targets. Now if we look at the FTSE underperforming in global markets, and that's really a bit concerning. It's bullish on the chart, so here we see the weekly candlestick. So this is a long-term chart where we're thinking a year out. It's looking bullish, but the fact is it's underperforming, and that performance is weighing heavily. And of course, with everything we're seeing in the US, with these, there's potential for 4 to 5% pullback, then you'd expect FTSE is going to feel that as well. We see the uptrend here. We do have a little bit more to play for on these targets. We haven't, unlike the US, we haven't got to the targets. But at the moment, it's hard to see that with that relative performance, FTSE outperforming the US. If the US is falling, FTSE, on the basis of the relative, will also fall, if not fall more. And on the 25 by 3, we see the 610 target, which was given and nearly met. And the fact that we didn't quite get there is a little bit concerning. That's sort of bearish in that we didn't get or exceed that target. And these 7,000, 6,900 takes us back to the all-time high on FTSE. We do see the thrusts, but we've got this new downside target of 5,625 kicking in. It is counter trend, but this, with the backdrop that we've got, we'd pay more attention to this 5,600 target. And then if we look at the daily chart, we see here the cloud. We really are testing the cloud on the daily in a much more serious way than we are on the S&P. So FTSE is already starting to look like it's testing this cloud. Here we see the seasonality for FTSE. We don't normally do that well. This is a 10-year average seasonality. We don't normally do that well in the first few months of the year. It's around the summer lately that we've been doing well. It's taking the last 10 years and looking at how the market behaves each day in the year. And then we see that we really do tend to have a worse second half. So the seasonality is a little like a seesaw. Sell in May and go away worked last year, didn't work the year before. Looks like with the US and everything that's happening, it might come a little bit earlier this year. When we look at the correlation, this is correlation to the US stock market. As you'd expect, it's normally very high. This daily chart, this is a 65-day correlation, so it's like a quarterly view. But we see how the correlation is dropping away. It's still correlated, about 60% correlated, but that's not as highly correlated as you'd expect. So FTSE is not quite doing what the S&P's been doing in the last few weeks. And then if we look at the 60-minute chart, we see in fact that comes through in the chart itself, because the US had this trend that was going up and up and up that really ended in February. FTSE was finishing its trend in January, so a month earlier this run was already starting to come under pressure. This sideways range, great for the RSI. We see how we get buy signals and sell signals for trading the range. So if you're trading FTSE, when you're in a sideways range, the indicator is good. If you're trending, you'll get overbought signals all the time. You won't get buy signals, which is what you want, because you don't get to those levels. So you'll get overbought signals in an uptrend and oversold signals in a downtrend. When you're in a sideways trend, you get both. So for trend trading, this is using the RSI is a good move. But of course the risk is with trend trading, if we break below and we see the pressure that we've got in markets at the moment, this buy signal could actually turn out to be the wrong signal to take. So you need to be aware of breaking these key support levels. You need to take the price always into account when you're looking at indicators. Remember, indicators are what they say they are. They're indicators. The price is really the key. And if we look at the 1 minute chart, this chart changes very quickly on your system. I know a lot of you using these, a lot of Updata users using these on your FTSE charts. You want to see if you're trading FTSE spread betting, these 1 minute thrust targets, absolutely key. We see last week's kicking in here, 5845, 5850, that was a cluster. Then we see we've got a new downside target of 5695, that's taking us another 100 points lower on FTSE, but we do also have a counter trend target. You need to watch how this chart develops this week. In the first few days of this week, you're going to get new targets off this 1 minute chart, and we see the downtrend pressure. You really should not be using these targets unless you've read Jeremy Duplessis' point and figure book. A little bit of knowledge is a dangerous thing. You need to understand how these targets work. Invented back in the 1940s and 50s, these targets, unique to Updata, really are key, and I know a lot of you rely on them. Right, let's take a look at Japan. Really quite obviously catastrophic events, and it's hard to know what it's going to mean for the Tokyo stock market this week, but really what we see here is that Tokyo has been in a terrible downtrend in the long term for quite some time anyway. So that means on the long term its susceptibility to down moves is higher, and although you can't predict shocks with something like an earthquake, what you can expect is that when you get this kind of news, the direction of the trend will be key. So in an uptrend we would expect a negative shock to be less than in a downtrend. So this is the monthly chart, and you know, really what's quite fascinating is if you overlay the US and the Japan market and shift the peaks, we see that we had very, very similar behavior in the run up to the 89 peak for the Tokyo market, and then the 2000 peak for the S&P. By aligning these up, this is a monthly chart, it was 127 months shifted back. It's the shift function on your Updata compare, and then you just can see what the Western market, if we have got something like the 1970s, that's how it looks. So really quite key in terms of, you know, markets are in this big range, and if we do see downward pressure, if we've got a Japan on our hands in the West, that's how it looks. So just another interesting way of looking at things. But here we see the Tokyo market. It's been underperforming globally. Most of us know that. But above the cloud on the daily and above the cloud on the weekly, I've overlaid the two clouds here. Easy to do on your system. Just go and select Ichimoku again, and then you can overlay a different time frame. And so we see the daily cloud and the weekly cloud. It has got support in terms of the short and medium term, so maybe, just maybe, Tokyo can hold these levels this week. Of course that long-term picture is not great, but the short and medium-term picture, we are bullish above the cloud. We've got targets, not much in the upside, of course, as you would expect with a downtrend, and 5,900, that's taking us a good, you know, 50 or 30% lower than where we are. I don't see that happening very quickly, but we do have this downside target hanging over us on the Japanese market. Got an uptrend in train, but that target is hanging over us until we break to a new high. It's going to be critical. And if we look at China, I get a lot of investors saying to me, oh, China is so exciting. Not on this chart. This is the Shanghai composite, and we see that we had the bubble in Chinese stocks very similar to the NASDAQ, and this 38.2 level weighed on us in 2009. We haven't come in close to testing these levels again. So the excitement in China is not happening in the stock market there. It's been and done. And we see here the underperformance. So China not looking great. But if you want to look at a market that is looking interesting, it's the Sensex. This is the Indian stock market. The Indian stock market is testing new highs. We want to see a break to a new high. But we do see here on the chart that this is one market that is testing its 2007 high. Not many markets doing this. We see the outperformance globally, a good 5-year trend, although we've pulled a little bit below trend, it is still a pretty good trend. We need to keep an eye on this chart for breaking a new high. Of course, you can push Shift T on your charts. You can get this off Yahoo on your Updata system. You can get the Sensex. You can push Shift T on your charts, Yahoo or Google on forgetting Sensex index, and you will get the upside target once we break. Of course, there's some downside targets to consider as well. You've got to be careful. Another market that has a similar looking characteristic is Brazil. We see the uptrend. Brazil has outperformed by about 5-fold in the last 10 years, and again it's testing its 2007-2008 high. So two markets that look quite different from Western markets at the moment. The BRICS, it's the B and the I that really counts, but wait for new highs. That's it for this week. I'm always happy to cover anything you like. Just send me an email and I'll do my best. Until next week, happy charting. See you then.